All ready for a bit of working capital then? You sometimes hear this, gross working capital, which is your total current assets. And then the one we're really talking about here is net working capital, which would be your current assets minus your current liabilities. Okay, so nice and straightforward. Your operating cash cycle, sometimes called your working cash cycle, sometimes called your cash conversion cycle. But when you buy stuff, you keep it in inventory, don't you? So let's say it's in inventory for 50 days. Then you sell it, but you don't get the money straight away, so it's in receivables. Let's say it's in receivables for 30 days. So do you agree you've had no cash for 80 days? And that's quite bad news, isn't it, having no cash? But there is some good news, because when you bought the item in the first place, it was also in payables for 40 days. And that's 40 days when you didn't need cash. So your operating cash cycle is you had 80 days no cash. We didn't need cash for 40 of them. So your operating cash cycle is 80 minus 40, which is 40 days. So in the exam, you want to remember it as your inventory days plus your receivable days minus your payable days. And you want that period to be as small as possible, ideally. Now, how you calculate inventory days, receivable days, and payable days is quite straightforward. Get to know how you do that, but that's not for the purposes of this little recap. Okay, so that's that. Now moving on to working capital policies. If you've got an aggressive policy, what that means is you don't have much in cash, you don't have much in debtors. And because you don't have much cash or much in debtors, you have a higher risk of liquidity, but you're using your cash well. You're getting your cash in and you're investing it, so you're going to have higher profitability. The opposite of that is a conservative working capital policy, where you've got high investment in current assets, so lots of cash, lots of debtors, high debtors, because you're wanting people to come in, you're offering them better credit terms so that you've got better liquidity, but you've got worse profitability because you're not investing your current assets as well. So, who wins in that? Well, that's an argument for the board. Managing the working capital, then, you might get questions on this. How can you manage inventory? Well, economic order quantity, that minimises your holding costs and your ordering costs when you get inventory. Just in time, there's no stock holding, you get the stock just in time, but that requires efficient supply, good relationships with suppliers. How do you manage your receivables? Well, you give them clear credit policies, you make sure you only get a receivable with somebody who you can trust, creditworthiness. You offer them early payment discounts, so you get your money early, or you can sell the debt onto a factor. That's another possibility. So how to manage your payables? Again, negotiate good credit terms. Pay them without risking the supply relationship. So what we mean is try and pay them as late as possible, but keep on the right side. Cash management, do cash flow forecasts. Make sure you've always got a reasonable amount of reserves and you invest that surplus cash. Nearly there then. Risks and challenges that come from dealing with working capital. This is a big one in the exam, when you overtrade, when you really try and do everything to grow your sales, but you don't have enough working capital. So you start relying on long-term capital for doing it. So you get big overdrafts, that sort of thing. And it's whether you can afford those big overdrafts. Seasonality, we should all know that, plan for the off-peak periods. And there can always be external shocks, supply chain disruptions, economic downturns, inflation, that sort of thing. Profitability, I want you to consider this. If you've got lots of debtors, lots of cash you're hanging on to it, what will your profitability be? This is the key thing to understand here. Having lots of cash and lots of debtors means they're idle. And what I mean by idle is they're not being invested. Good for liquidity, but bad for profits. So let's flip that over. Looking at profitability still, but this time low current assets and higher relatively current liabilities. Well, you're using up all your assets well, you invest in all your assets, so you get higher profits, but can you see you've got lower liquidity, more risk, because you have to pay off these liabilities. Okay, that's everything really. So I hope you enjoyed your little recap, your little walk through working capital. Really, really useful. Once you get on top of it, it's a great little subject.